In early March 2026, the silver market suddenly experienced a terrifying roller coaster of surging and plunging prices. Countless retail investors threw away their blood-stained chips at the bottom in panic. Is this a collapse indicating a market peak, or a malicious institutional washout? Today, Passive Intelligence takes you through the fog. This is by no means an ordinary fluctuation. Next, we will dismantle the underlying logic for you in 3 parts. Stay tuned, and you will see through the market maker's tricks and hold on to your core assets. Part 1, the Federal Reserve's Impossible Trinity, Deadlock. First, look at the macro cards. The Fed is now trapped in an unprecedented impossible trinity. Daren't cut rates, energy and geopolitical risks haven't been resolved. Cutting rates now could cause inflation to rebound at any time, repeating the nightmare of hyperinflation. Daren't hike rates, macro data is already flirting with the edge of recession. Further rate hikes could lead to a hard landing for the job market and the real economy. Daren't delay either, the Treasury yield curve remains inverted, and shadow banks face the risk of a liquidity crunch from massive redemptions at any time. Looking at the U.S. fiscal data for the first quarter of 2026, monthly spending far exceeds revenue, and the deficit is deteriorating rapidly. Under the immense pressure of the election year and debt interest, we boldly predict, the Fed is likely to be forced into an emergency rate cut in the coming months. Once it lands, the 1970s stagflation script will repeat, providing the superfuel for a gold and silver explosion. Part 2, the paper dump tactic of Wall Street giants. Since the fundamentals are long-term bullish, why has silver been fluctuating so violently recently? We found clues in the 13F filings disclosed in mid-February 2026. Wall Street quantitative giant Jane Street aggressively increased its holdings of SLV by over 20 million shares at the end of 2025, becoming the largest holder of the fund. This institution's methods are extremely aggressive, having been involved in massive tremors in the crypto world. Therefore, there is strong speculation in the market. The violent sell-off since March is likely the main force deliberately depressing prices in the paper market to block a technical breakout. The goal is simple, to wash out weak-handed retail investors and monopolize the subsequent profits. Part 3, the truth of historical washouts in the Weimar Republic. In the face of such extreme volatility, how do you hold on to your chips? Let's look at the hardcore history of the Weimar Republic in Germany from 1914 to 1923. Back then, under extreme credit currency overissuance, the price of gold soared from 100 to a staggering 10 billion. But please note, even in such a straight-to-heaven market, the monthly drawdown volatility of gold once reached as high as 160%. Looking at the 1970s, silver's journey from $1.50 to $50 also saw multiple violent washouts of 25% to 30%. The conclusion is clear, in a cycle of wealth transfer, surging prices are inevitably accompanied by violent washouts. Countless people will panic sell because they cannot withstand short-term drawdowns, ultimately missing out completely. In summary, as long as you recognize the long-term trend of declining purchasing power of fiat currency and the Fed's current dilemma, don't be fooled by the technical noise created by Wall Street on paper. Follow Passive Intelligence. You sleep soundly, I handle the intel.